bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the January 9th, 2024 podcast. Let me begin our first podcast of 2024 by wishing each and every one of you a very happy new year. Today's podcast is another in our ongoing series, So You Want to Be a Local Housing Tax Credit Developer. Our Local Housing Tax Credit Developer series is intended for anyone interested in the development of affordable rental housing using low-income housing tax credit equity. Now, our primary target is current and future LIHTC developers, but the topics covered are relevant to all involved in the development and operation of affordable rental housing. Now, the local housing tax credit is used by developers to raise equity to fund either one, new construction of affordable rental housing, or two, the acquisition and rehabilitation of existing buildings for use as affordable rental housing. Understanding that there are these two distinct uses of the housing credit is fundamental to using this tax incentive. In today's podcast, we're going to focus on the latter of these two options, namely acquiring and renovating existing buildings for use as affordable rental housing. These types of developments are commonly referred to in a more abbreviated way as Acq Rehabs or Acq Rehab developments, obviously a shortening of acquisition and rehabilitation. Now, as those of you who are watching on YouTube can see, my guest today is my partner, Christina Apostolidis, an expert in local housing tax credits. Christina is joining me to discuss some of the basics of Acq Rehab tax credit developments and some of the important distinctions between Acq Rehabs and new construction development. And those distinctions relate most notably eligible basis calculations as well as tenant compliance. Now, fundamentally, Acq Rehabs and new construction are very similar. For both uses, an owner can only claim tax credits on the portion of the property that is rented to low-income tenants and for which rents do not exceed HUD-defined rent limits. Also, for both, the property owner must receive a tax credit allocation from the tax credit allocating agency or use private activity bonds to finance at least 50% of the land and building costs. With that said, there are some notable distinctions or differences, which is why we selected this topic for today's episode. These differences include, in an Acq Rehab development, the cost of the existing building and the cost of the renovation are treated as two separate buildings. This means that there'll be at least two IRS Form 8609s for each physical building. Also, in an Acq Rehab development, the property often has tenants living at the property before the renovation begins, which has additional implications. If the tenants are in place during the renovation, then the calculation, qualifying basis, and determining the low-income housing tax credit occupancy percentage is notably more complex. Now, my guest today, my partner, Christina Apostolidis, is based in our Naples, Florida office. I will note, if you're interested in meeting her in person, you'll have that opportunity next week. She is the chair of the Novogradac Affordable Housing Developers Conference coming next week to Fort Lauderdale, Florida, and I will be in attendance as well. In a moment, Christina will share a bit more about the work she does at Novogradac. But I do want to remind you of some of the other previously recorded podcasts in the So You Want to Be a LIHTC Developer series. They include such topics as final cost certifications, location and market considerations, understanding investor concerns, what you should know about Form 8609, and much more. I will share links to all the previous episodes in today's show notes. But today, we're focusing on acquisition and rehabilitation developments. So if you're ready, let's get started. Christina, welcome back to Tax Credit Tuesday.
Thanks, Mike. It's great to be back.
Excellent. Now, before we dive into specifics about acquisition rehabilitation developments, please share with our listeners a little bit more about what you do at Novogradac.
Yes. So I've been with Novogradac for 17 years, and I work closely with developers and syndicators of affordable housing. And I very much enjoy working sort of on both sides of the transaction because I feel like I can connect with our developers and help them understand, what their investors are looking for, and vice versa. So I really enjoy that. I work a lot with new construction deals, uh, Acq Rehab, and taxes and bond transactions as well. I'm also the upcoming chair of our conference, like you mentioned. So I'll see everybody there next week. And this podcast is perfect because it's kind of going to be a high level overview of acquisition rehab, but we're having a workshop at our conference next week on acquisition rehab, which will go through a lot of examples to really give our audience and our workshop attendees a good understanding of acquisition rehab. So the workshops are great because a lot of times people bring their specific examples or specific questions. There's a great way to kind of work through some of those. So I really enjoy doing the workshops also. But yeah, that's kind of a little bit about me, and looking forward to seeing everybody at the conference.
Well, thank you, Christina. I look forward to seeing you in person next week. So let's start out with a question that's fundamental to this subject matter today, and a question that I suspect some viewers and listeners are wondering about. So when we talk about acquiring and rehabilitating a multifamily property, let's start with the acquisition part. What types of buildings are eligible to be acquired and renovated using long-lasting cash for equity? And to a certain extent, that's not a fully informed question. So let me reframe that. Any building can be acquired and you can claim tax credits on the renovation. However, if you want to claim tax credits on the building, the cost of the acquiring the building itself, there are certain rules. So maybe you could talk about the rules around the types of buildings that are eligible to be where you can claim tax credits on the acquisition costs.
Yes, great. And that's a great place to start, right? So when we're talking about acquisition rehab, we're referring to an owner acquiring an existing building with a plan to rehabilitate that building. And that existing building may have been previously a LIHTC building. We refer to those as re-syndication, right? So meaning that the rehab is being completed under a new tax credit allocation, or that building just might have been any multi-family rental housing building, right? In either case, the acquisition rehab is a valuable tool for developers, and they can use that to either preserve existing affordable housing or bring other existing rental housing under a long-term affordability restriction, right? And this is super important now more than ever. In cities across the country, tenants are at risk of facing being displaced from their current homes. So acquisition rehab really helps local governments, and local developers to help, this population that, are at risk of losing their homes due to increasing rents. So just as in the new construction development, the eligible costs incurred to rehabilitate the LIHTC units are used to determine the tax credits, but in an acquisition rehab development, the acquisition basis, like you mentioned, may also be eligible for tax credits, right? So specifically, the portion of the purchase price allocated to the building is eligible for tax credits. And we'll get more into that a little bit later. But being able to earn credits on the acquisition basis is key to getting these developments done because it brings much more needed tax credit equity to the capital stack. So it's important to note here that the rehab must be completed, right? So the rehab has to be completed for the acquisition credits to be taken. You can't just take acquisition credits alone. Okay, so that's why we call it acquisition rehab. But yeah, so specifically for that acquisition basis to be allowed, there's two specific rules that we have to make sure that the building is meeting. And so those two rules, we call them the 10-year hold rule and the related party rule, right? So these rules only apply if you want to take acquisition basis and get acquisition credits on that basis. Sorry. So the 10-year hold rule, the IRS requires that the acquired property must have been previously placed in service at least 10 years ago. Okay. And there are a few exceptions to this rule, but I'll share the two most common that I see and that I deal with. So again, this is an important rule. Last time the property was placed in service must have been at least 10 years ago. One exception is that this 10-year hold rule does not apply if the development is substantially assisted financed or operated under a federal or state housing program, such as, so we see this a lot, Section 8 deals, HUD programs. It works with a lot of developers that have taken their aging HUD portfolio, learned about tax credits, and use these to really bring these aging buildings back into, good operating order. So it worked a lot with them. So this is great. Again, just really helps the community, helps them to, using tax credits to rehabilitate these old prior HUD projects. Um, Another exception that we see a lot and is really helpful is that the initial 10 if a building was held in service for at least 10 years, and if any transfers happen after that initial 10-year hold period, this 10-year hold doesn't apply. So it's another exception if there's a transfer by a nonprofit or a government entity. So again, we see this a lot as well. I work with a lot of nonprofits too that do affordable housing, and they make use of this exception. So just to kind of recap that, with the 10-year hold, there's exceptions that 10-year hold period doesn't apply if it's substantially assisted with federal or state housing programs, or if there's transfers by a nonprofit or government entity. So this is an important one to know. And like I mentioned, we are having a workshop next week, but we also host a webinar, which is great. And we usually have that one once a year. So watch out for that. We go into a lot. There's a lot in the 10-year hold rule. There's a lot more exceptions as well. And a lot more things to know about there. But, if you're thinking of doing an Acq Rehab, you want to know these rules because you do not want to mess it up. You don't want to mess up being able to take the acquisition basis for credits. So that's our 10-year hold. The other rule, like I said, there's two rules. The other one is the related party rule. So for acquisition basis to be considered for eligible tax credits, the acquisition cannot be between a seller and buyer that are related. So that means that there cannot be common ownership of 50% or more of the seller and the buyer entity. So again, these rules can get really tricky, and there's a lot in there. So again, before acquiring a property, we want to make sure that we're aware of these rules so that developers, don't mess up anything in the acquisition of it. Like we said,
You're right.
being able to take that acquisition basis is key and big for the project getting done for more tax credit equity.
Great. Thank you for that, Christina. And I would just note that in terms of the types of properties that we typically see at Novogradac are going to be re-syndications, multifamily rental housing that hasn't had tax credits before, but is being acquired and renovated and using tax credits to provide that and rent restricted units. But we also have that third category where the property is an existing building, but has been used as rental housing. And it basically gets repurposed as rental housing, like the old schools, lots of examples of different types of properties that can be converted and repurposed into affordable rental housing. So that's just some of the other examples. And when you mentioned the 10-year hold rule, the related party rules, I would just note for listeners that there are structuring ways to handle the related party rules. So that's more about, just making sure you have adequate advisors to consult with about that. And with respect to the 10-year rule, similarly, as Christina mentioned, there are exceptions to the 10-year hold rule. The general rule, it has to have been the last place in service 10 years ago, but there are certain exceptions. And the overall advice here, I think, is before you buy the building, talk to an experienced tax advisor so you understand what it is and how you structure the transaction to avoid violating the 10-year hold rule and tripping up your ability to claim tax credits.
Correct.
So anyways, I could keep talking about that for a moment to further build upon your great overview, but let's move on. In the introduction, I talked about some of the key differences between new construction and acquisition rehab. So if I'm someone listening to the podcast or viewing the podcast, and I've been involved only in new construction, tax credit development. Please share some of the central differences between Acq Rehabs and new construction. And I would say, if you could just go do that at a fairly high level, and then we can follow up with additional dig down in some of the areas that you'll mention at a high level.
Yes. So when we're thinking about the Acq Rehab and how it's different, we really need to think about the tax credit calculation, because that's where there's going to be some differences. Essentially, it's the same calculation, but what goes into the specific factors um, can change, right? So just as a reminder, when we're thinking about the tax credit calculation, right, we start with our eligible basis. And again, in Acq Rehab, there's going to be some differences that we have to keep in mind of what makes up our eligible basis, right? So we start with eligible basis times our low income occupancy percentage, and that gives us our qualified basis. And then our qualified basis times our tax credit percentage gives us our annual tax credits. It's very simple. There's a couple of factors there, but there's differences whether it's a new construction project or an acquisition rehab. And then also, as a reminder, in the first year, right, our first year credits is always going to be a partial year usually. And so in the first year, only the tax credits apply for the portion that the building was leased to low income tenants, right? So specifically with Acq Rehab, one thing that's different, and it's kind of weird sometimes for people, and I think some people when they see it are surprised. But you mentioned this earlier, and there'll be two separate 8609s for each one of your buildings, right? So if your project is 3 buildings, you'll have 6 8609s, because each one of those buildings will have an 8609 for the acquisition and an 8609 for the rehab. So again, when you're looking for 2 of them, but so some of the things that we want to touch on specifically with the calculation, like we mentioned, another uh, uh, area where the calculation differs is when we talk about having the bonus to your eligible basis, right? So then if your project qualifies because it's in a QCT or in a DDA, uh, that additional bonus is only applicable to the rehab portion of your acquisition rehab development. And why is that, right? So, the IRS allows for that 130% basis boost only for the portion of which you're going to improve the property, right? They don't want to incentivize that people are buying, buildings and getting that basis boost just on the acquisition, right? They want to incentivize the actual improvement and rehabilitation of that building. So it's one of the things to keep in mind when you're doing the calculation, that basis boost does not apply to the acquisition basis. And then determining the low-income housing occupancy percentage as well, especially in that first year with an acquisition rehab. Remember, you can acquire this property and you can have tenants in place. So when there's tenants in place, there's a difference, and a lot of things to keep in mind there. So we'll touch on that as well. And then the tax credit percentage, right? So we know that we have 9% deals, we have 4% deals, right? So our 4% deals, we usually think about our transactions financed with tax exempt bonds, right? And when we think of 9%, we think of our new construction deals usually, but that's not always the case. You can have an allocation of tax credits or a competitive allocation of tax credits for an acquisition rehab deal. Your acquisition portion is always going to be 4%. Again, kind of along the same logic with the DDA and the QCT bonus, right? The IRS wants to incentivize, and they're going to give you a higher credit rate, tax credit rate for the rehabilitation portion. So your acquisition basis tax credit rate is a 4%, but your rehab potentially, could be a 9%.
Great. Thank you for that, Christina. That's a good overview. And I always find it useful myself to think eligible basis times occupancy percentage equals qualified basis times tax credit percentage equals tax credits, and then break out each of these areas in terms of how they're different with new construction or Acq Rehab. And, you did mention that if you're eligible for this 30% bonus because you're in a DDA, or if you have allocated credits, the state designates you as eligible on the renovation piece. You're going to have a bias towards wanting more costs to be renovation costs than acquisition costs, because any cost that goes into the renovation side would get this 30% boost. Whereas on the acquisition cost, you wouldn't be eligible for that 30% boost. But there's also other ways in which the basis of the two, you have to be mindful as to where particular cost is capitalized. So maybe you could share some of the areas where the eligible basis for Acq Rehabs can differ than that for new construction.
Yes. Yeah. So right from the very beginning, one thing to keep in mind is the purchase, right? So when we're talking about acquiring an existing building, the acquirer, the purchaser, pays a purchase price for that building. So how much of that purchase price is considered acquisition basis? Usually we look to an appraisal. So you have to keep in mind that not 100% of that purchase price is applicable to the building. And an appraisal is helpful to understand, what did you buy? What did you purchase? You purchased land, you purchased a building, maybe you purchased some personal property and some land improvements, right? So really understanding what makes up your purchase is going to be helpful, so you can separate out what belongs in acquisition and what belongs in your rehab.
Let me just
So
actually interject there. Sorry to interrupt, but I think, your point about appraisal is really helpful with that. It's also, as you know, helpful if the purchase contract itself just states this much has been going to land, this much building, each of these various categories, obviously supported by an appraisal, so that when you're doing your cost cert later, it's easier to identify this is the building cost, this could be the renovation costs, and the acquisition basis. But I wanted to also just emphasize the fact that there is sort of a step into the shoes type rule, where if the seller had some level of renovation costs, a portion of the purchase price can be allocated to those renovation costs, such that, your purchase contract is at either acquisition costs or land rather than non-qualifying costs. It could actually be, you could be purchasing kind of renovation costs that are in process. So that's an important distinction for developers to be aware of, particularly if they're in a difficult to develop area. But sorry for interrupting. I
yeah, no,
got a little bit of a depth, and we obviously can't cover all the intricacies of Acq Rehab, and I'll try to hold back and not keep inserting additional levels. This should be more of a 101 versus a 202.
yeah, and just kind of like reiterate what you said before. Before you acquire the property, consult with
Yes.
your tenants credit team to kind of point some of these things out, like you said, in your purchase contract. Understanding what you're buying, and some of those, make sure those questions are being asked and brought up. But yeah. So other things to consider, like you said, there's sort of your acquisition basis and in your rehab basis, and there's a lot that goes into that. So during construction, you have to be conscious of, where does that basis belong, right? So what's, particularly when we're thinking about some of our soft costs. So as an example, interest expense, right? So in a new construction deal, it's kind of easy, that the project is being construction, your construction interests and some of the other soft costs get capitalized until the building is complete. You get a certificate of occupancy, your building's in service, you stop capitalizing certain costs. But when you're thinking about an acquisition rehab project, you have to remember you're likely acquiring, in a lot of instances, a building that's already in service, right? So You already have tenants living in it. It's operating. You're collecting rents. So some of those soft cost considerations, your cutoff or determining what portion can get capitalized is different. So you really need to understand that. And particularly when you're thinking of, upfront and you're running projections and forecast of how much tax credits are going to be eligible, that's an area I see where, forecast, nothing ends up like the forecast, but usually that's an area that definitely doesn't end up like the forecast. So especially if, we weren't, being very careful about, making sure what costs are eligible to be capitalized. Um, so that's where another, thing that, a big dollar amount that usually gets split between acquisition and rehab is your developer fee too. So you have to be conscious that a portion of the developer fee will go or may go to your acquisition basis and a portion will go to your rehab. So again, remember your acquisition basis is 4%. Your rehab tax credit rate might be 4% or 9%, 4% if it's a tax exempt bond project. So there's not really too much there because it's 4% and 4%. But if your rehab is eligible for 9%, that could be a big difference too.
Or if your rehab's eligible for the 30% boost, it's 12%.
Yeah, exactly. Yeah. So being conscious that, some of these costs are not as straightforward, when you're thinking about the tax credit calculation, where they end up, makes a big difference.
And also note the developer fee. Now, this has been something I think sort of conceptually, a lot of states will have a lower developer fee based upon the acquisition basis and a higher developer fee based upon the renovation costs.
Yes.
And then a number of state agencies will, as part of their allocation process, say that the developer fee, that's as a percentage of the acquisition cost, should be capitalized to the acquisition. And the development fee that's based upon a percentage of the development cost should go to the renovation. I myself think conceptually the developer is being incented to renovate the property.
Right.
And the developer fee limits are based on the acquisition cost and or the renovation cost, but the actual, from a tax perspective, the capitalization of the fee itself should be for the renovation, should be capitalized 100% in the renovation. But a lot of state agencies don't agree with me. At the end of the day, anything with the tax credit, you have to comply with what the state says and what the IRS says. The IRS were to give guidance, contrary to a state, you have to follow the IRS. Or I shouldn't say that. I should say the least common denominator. You have to take a position that satisfies both what the state requires and what the IRS requires. So in the example I'm talking about, while I might argue that from the IRS perspective, you should capitalize the developer fee to renovation, if the state doesn't let you, then you're not going to get to.
Yeah, that's a very good point, especially working in different states. We see that as a big difference and sometimes comes as a surprise to the
Right.
developer or the team. So if you're a developer looking to get into a new state, definitely, and that can be a whole other podcast, but
That's what I was thinking. We don't have another podcast on how it's different.
Yeah, where the states
Some of
can
these
differ,
issues.
it's a big deal. And like I said, sometimes it comes as not a good surprise. So when we're doing the cost certification.
So thank you for that. So we've sort of talked about eligible base. There's a lot more we can talk about there, but let's move on to determining qualified basis, which means we have to determine the local occupancy percentage. And, the local occupancy percentage, is the portion of the units that are rented to low-income families at restricted rents. And the interesting thing about Acq Rehab is you could have tenants in place during the rehab, or the property could be vacant, such that you don't have tenants in place. So it's either going to have tenants in place or not. Maybe we'll start with the easier situation. Suppose you're doing an acquisition rehab and you don't have tenants in place. How is the low occupancy percentage determined? And is it really any different than new construction?
Right. So so not real different than new construction, right? So you acquired your building's not placed in service, right? So most likely you're going to consider your building placed in service once your rehab is complete. So very similar to our new construction tax credit calculation there. Yeah, not
Yep.
too much different there. So that makes that makes it pretty easy.
Yeah, it makes it pretty sort of straightforward. Now, it's not so straightforward when you have tenants in place at the start of the renovation and during the renovation. So maybe explain the complexities and opportunities in terms of your local occupancy calculation when you have tenants in place.
Right. So definitely the first year tax credit calculation for an Acq Rehab deal with tenants in place, there's a lot there and a lot to kind of consider and remember. And I feel like every time we do a deal, I go back and kind of refresh my memory because there's a lot there that you don't want to miss and you want to be constantly thinking about. But with an Acq Rehab deal with tenants in place, once you acquire your building's already considered placed in service, right? So, which is great, because once you determine that you have qualified tenants, right? So your building's already in service. And what do we know from, I guess, a new construction deal, right? We know that our building has to be placed in service for at least a full month. Um, Before we can start taking credits, right? So if our building was in service in June and we move somebody in June, we can start our credits in July, right? So we need our building to be in service for a full month. So with an Acq Rehab deal, once we acquire it, our building is already in service, right? So we consider that to be placed in service. So that's the place in service for our acquisition. And you will see that when you do your 8609, your acquisition 8609, it's placed in service will be the date of your acquisition. Now we have to think about having qualified tenants in place. So if we have qualified tenants, and we'll kind of go into that a little bit as well in a minute, but once we have qualified tenants, our units are potentially eligible to start taking credits once the rehab is complete. So, with as an example, if we acquired our acquisition rehab development in 2023, our building is considered placed in service. And if we complete our rehab in 2024, that's 2024 is the year that we can start taking credits, right? So with our acquisition rehab, we take the credits together. That's the other thing, right? We can't take acquisition credits alone. We can take acquisition and rehab credits, but we can't start taking credits until our rehab is complete. So that's one specific thing to really keep in mind. So, but once our rehab is complete, we can go back to our acquisition date if our tenants were certified and we had eligible tenants. Assuming we had eligible tenants at acquisition, we can go back to the acquisition date. So as another example, if we acquired our building January of 2023 and we completed our rehab in December of 2023, they're completed in the same year, right? So our acquisition and rehab, we know we're going to take together. And we completed in 2023. So now they're done. We can start taking credits. We can go back. We don't have to wait till December as that's our first month to start taking credits. No, we get credit for the fact that we had occupied units with qualified tenants since January, right? So we go back to the acquisition date. So it's either the acquisition date or the start of our credit year. So in my example earlier, if it was 2023 acquisition and a 2024 rehab completed, right? We can't start our credits until our rehab's done, right? The IRS wants to make sure we got that rehab done. So we can start in 2024. We would go back to acquisition, but we can't go back to the start of the year, right? We can't go back to before January. So we would start taking credits from January of 2024.
Great. Thank you for that, Christina. There's obviously a lot on this topic that we could cover, and we can't cover it all in a single episode. But I would like you to share with listeners anything else you think we should be sure to talk about in this episode, beyond what we've covered already.
Yeah. So just kind of two quick takeaways with that. Just kind of remember that we can't, we take the credits together, right? We take acquisition and rehab credits together. Um, so if you have tenants in place, just one big thing to keep in mind is you want to make sure those tenants are certified um, at acquisition. And so there's a lot of rules there too. But if you're doing an acquisition rehab project, you want to know your population in that building because you want to be able to maximize your credits in that first year. Meaning that you want to make sure if you have certified low income housing tax credit renters in that building. So there's a rule that from acquisition, you have 120 days before or after to make sure that your tenants are certified. And if they are, their effective date of their certification is the date of acquisition. So that can be, a really important thing to know so you can maximize your tax credits when you're calculating your first year's tax credits. And then also, like, there's a lot of differences and nuances, but we just want to make sure that, a lot of these things, differences in timing, the other big thing too is, you want to know, do you have tenants that are potentially eligible to be certified, right? Maybe you have tenants that are over income. So there's a lot of, strategies or what needs to happen to make sure that you have a population in the building that's going to be eligible for certification. So knowing that, but like we mentioned in the tax credit calculation for an Acq Rehab project, there's a lot of differences and changes can really cause a big effect on the annual tax credits, and particularly in that first year. So really from acquisition or even before acquisition, right, you want to make sure constantly kind of looking down the road throughout from acquisition to placed in service, understanding if there's any changes from what was initially thought to what actually happened, because there's could, potentially have a big effect on the tax credit calculation.
Thank you for that, Christina. And let me just note for our listeners, if you're interested in more information on Acq Rehab properties or have questions, I will be sharing Christina's email address in today's show notes. And I'd encourage you to join us next week at our conference in Fort Lauderdale. And I will share the links to the conference. And there's also a webinar on our website from October. So I'll share a link on that as well, dealing with Acq Rehabs. They'll be shared in today's show notes. And as I mentioned earlier as well, I'll include links to the previous podcasts. And so you want to be a LIHTC Developer series. Now, our off mic section is coming in a moment. But before that, I do want to ask each of our viewers and listeners to take a moment to subscribe to Tax Credit Tuesday on your favorite podcast platforms to ensure you don't miss an episode. And every week, I like to encourage our listeners to email us if there's a topic you want us to discuss on a future episode. And you can send those emails to CPAs at novoco.com. Now, I will turn to our off mic section. And this is the section where I get to ask Christina some fun off-topic questions. And we in the accounting world are now entering our busy season, which means we have a lot going on for the next few months. So Christina, what tips do you have for someone who plans to stay on top of things during such a busy time?
Yeah, definitely busy season can get hectic. And when I feel like it starts heading that way, I encourage my staff too, is one thing I tell people is, really setting aside time for your big projects. So whether that's, one thing like mentally, I just like to know that Monday I'm going to target, this project or this client or this specific type of work. and really just setting aside some kind of blocks of times where I feel like I can get a chunk of work done for different things. So Monday will be one thing, Tuesday will be another, Wednesday. Um, and that way I feel like I got enough and a lot accomplished for a lot of different things, because it's easy to just kind of get off track, and sometimes issues come up or changes or things, and you really get absorbed uh, into maybe one particular issue or problem, or so you just really want to be able to keep focusing. There's a lot, right? There's a lot that we have to keep track of, and so I feel like kind of doing that mental specific scheduling of blocks for each day. I know by the end of the week, I accomplished a lot.
Time management is always important, never more important than a very busy time when you're juggling more tasks. So one other question for you, which I don't think I've asked you before, but you've been on a guest on a number of episodes. What do you know now that you wish you would have known at the start of your career?
Oh, wow. That's a lot. That's like the crystal ball.
Or the reverse crystal ball?
Right, right. Yeah, I think, I mean, I know now that I don't know everything, right? I feel like, when you graduated college and you start your career, I think we're so focused on the technical, right? You're ready to you start your new job and you want to continue learning all the technical things there is to know. But, I feel that to my younger self, I would have encouraged some of the not technical stuff, like to stay on top and continue learning and read books kind of earlier in my career of some of those maybe soft skills. And, it's really encouraging some of my younger people to, because I feel like they're ready to get out of school. They're ready to just learn about tax and audit and, everything that we do at Novogradac. I think it's easy to lose sight of, maybe some of those other skills that are also important throughout your career, and keep, honing on those as well. So, yeah.
Good advice. That's great point about someone entering their career and they've been trained in school with certain technical expertise that are focused on growing that technical expertise, and there's all these soft skills that are kind of very important. And the longer you're in business and serving clients, the more important many of those soft skills become. So kudos for suggesting that. Well, thank you, Christina. I appreciate you joining me on the podcast today. And to our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast, or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.